Lalit Nambiar of UTI Mutual Fund to chat a bit more about the fundamentals and how the markets are looking right now. Lalit, hi, good afternoon. We're at the fag end of the earnings season. Let's start with your assessment of how, what you make of the numbers that have come so far. Most of them are out. Which are the sectors that have really stood out for you this time around?
I think broadly the numbers are in line with expectations. I don't think there are any major surprises on the top line front. A few places the margins were a little, probably a little less than what we thought it should be. I think critically, if you look at the capital goods space, you found some top line numbers which were auguring well, and that sort of matches up with what we're hearing on the capex front. So maybe very, very early signs of some kind of pickup in capacity creation. Although I'm not too sure now with the liquidity situation being what it is and credit growth as well as deposit growth being what it is, I don't know how much it will show through in the coming months. So we could have a slightly flatter capex cycle recovery and it could get muted. But I think that is a big takeaway from the results as well as from whatever economic data we're getting. So I think one space to look out for the next 6 months to 12 months could be the capital goods construction slash infra space, simply for activity. And then of course there is also the issue of elections coming around, so perhaps it will be a little stretched out and elongated as a cycle.
Talk to us a bit more about the liquidity concerns. I mean, time and again, a lot of key stakeholders within the banking and financial space have tried to assure the street that liquidity concerns are getting taken care of and are subsiding a fair bit. Even SBI chairman earlier on in the day said that there are no major liquidity issues as far as NBFCs are concerned, which he is seeing at this point of time. What would be your take on the entire situation and how early is it likely to get resolved?
So the first thing is I think history tells us that these crises, especially in the NBFC space, is not new. It happens off and on, maybe once in 7, 8, 10 years. And the manifestations are different each time, but largely it is always about rushing after growth, not so much astute lending, especially to sectors which may not be well placed. So that's the ingredients are all typically the same. This time around, I think the government especially is aware and sensitive to the requirements. I think there's some learning there from past events, and I think they've tried to control the descent in a sense which could happen with certain names in the sector. And to that extent, I think over a period of the next few months, we expect the issues around the government and the RBI and SBI all coming together and trying to give a very smooth landing here. Obviously, there will be hiccups. I mean, everything won't go as predicted. But I think the extreme flashpoint which people were worried about, I think that is perhaps past. Of course, I could be wrong, but it looks like it's past. But generally speaking, the tightness will, I think, remain. Especially for some of the NBFCs who have been prone to taking slightly more risk. So net, it looks like it's not going to be as easy as it was, let's say, the last 1 year. Simply because if you look at deposit growth and credit growth for banks, you look at how much exposure they took to NBFCs, and you know that at some level the pendulum has to swing back a little. So my sense is that while things are not in an extreme crisis zone, things aren't going to get better very quickly. So it's going to be a very slow kind of correction. You'll see a lot of NBFCs curtailing their lending as they find it more difficult to borrow easily, as they find it difficult to justify in terms of return on assets. Perhaps growth will get a little muted.
All right, Lalit, on that note, thank you so much for taking time out to chat with us about the fundamentals of the market.
Thank you.